Good afternoon. I would like to thank you all for joining our webinar today, especially our distinguished panelists, Minister of Finance Christos Staikouras, Dr. Daniel Gros, Director of HBS, and Professor Nouriel Roubini. The Harvard Business School Club of Greece has a long tradition of inviting world-renowned speakers to address the important issues, from the global crisis of 2008 to the Great Debt Saga to the European Union's structural challenges. The COVID-19 crisis has lasted longer than expected, imposed an unprecedented recession, challenging our social, economic, and geopolitical status. In everyone's mind, there is a vital question: how will the COVID-19 affect the global economy, our industry, and our livelihood? The national governments and institutions try to strike the balance between managing the virus' impact on citizens' health and normalizing the economy. The United States, the European Union, and Japan provided significant levels of emerging fiscal support combined with extraordinary monetary policies, hoping that the domestic demand will drive the recovery and will strengthen the world trade. They aim to reinforce the health systems, ensure social coherence, and provide stimulus to the economy. The digital transition has accelerated, but creates new social divides and broadens the inequality. Given the dominant roles of the United States and China in the global economy, their ongoing conflict over trade and technology generates additional uncertainty during this pandemic, while prolonged recessions in developing countries might lead to debt and inflation crisis. When a vaccine becomes widely available, an acceleration of economic activity is expected. The recovery that undoubtedly occurred in the second quarter of 2020 in many countries, unfortunately, could become an illusion if they suffer an intense second wave of COVID-19 or if our high hopes for early vaccine are misplaced. Concurrently, the pandemic also brought a reassessment of our core values, our work-life balance, far-reaching changes on how we work, how we interact with people, how we consume goods and services. It also raises some important questions. Are we moving to a V-shaped recovery or another type and timing of recovery? Will the insecurity fueled by the pandemic weigh on the global economy, affecting its growth, employment, and politics for the long term? How far the fiscal and expansionary monetary policies can go in underwriting this economy? Are the negative rates sustainable for the long term? What will be the exchange rate between euro and US, given the liquidity actions by the Fed and the European Central Bank? How will the inflationary pressures actually develop? This pandemic recession is different. It's a sectorial recession. It brought very sector-specific demand and supply disturbances. The sectors which suffer the most are international travel, entertainment, and hospitality. All these are important segments for the Greek economy. This July, the European Union agreed on a new temporary recovery instrument, a large package of grants and loans for the member states, the Next Generation EU. This represents in itself a fundamental advance in European solidarity and integration. The Recovery and Resilience Facility, which provides grants, will finance specific projects selected by the member states, but most importantly, will foster the structural reforms in order to accelerate their green and digital transition and their growth potential. Given the abundance of liquidity by the recovery fund and the tight deadlines, how efficient and productive will be the selection, allocation, and implementation of the projects by the Greek government? Which are the effective structural reforms financed by the recovery fund that will strengthen our economic growth? The recovery fund also raises a major challenge. Can the state and private sector agree to forge new dynamic synergies to transform the Greek economy and the Greek society? We have invited these three distinguished panelists to address these issues. The Minister Christos Staikouras will address the status of the Greek economy, the government actions to allocate the European funding, and the actions necessary to promote the growth. Professor Daniel Gros will present the status of the European economy, the prospects of Germany's economy, and the next generation of European funding. Professor Nouriel Roubini will give us his views on US economy, Chinese economy, global economy, and the financial markets. Professor Nouriel Roubini, thank you.
Hello, everyone. Thank you very much for inviting me, Stelios. Great honor and pleasure to be on this panel with the distinguished minister and Daniel Gros. I would like to give you a perspective of how this COVID crisis is affecting first economies, policies, and markets, with an emphasis on United States and on China, but also with a perspective on what the financial markets are telling us. And since many in the audience are from financial markets, I think it's good to start asking what are the financial markets telling us today. We know US and global equities initially in February and March collapsed 30 to 40% because of the crisis and the shutdown. Then they recovered rapidly because of reopening of economies, massive policy stimulus, and hope that eventually a vaccine will come. And they grew into August, in US even reaching new highs, like a V-shaped recovery of equity markets, at least in the US. But markets have become more volatile and more wobbly and beginning to correct again in September. Initially was the high-flying tech and growth stocks that were maybe, in a bubble territory. But in the last few days, there has been also a beginning of correction of more cyclical kind of stocks. And I think that the markets now are starting to worry about the following 10 factors that are going to enumerate in brief. Factor number one, the number of cases in US, in Europe, in emerging markets is rising, new cases of COVID. Secondly, we're going into a fall and winter in the Northern Hemisphere, and with cold weather, the cases could rise. 3, the prospects for having a vaccine already by the end of this year look less likely. We might have it only sometimes next year, so we'll have to pass through a winter without it. 4, in the United States, we have a massive fiscal cliff as Democrats and Republicans are not agreeing on another needed fiscal stimulus. 5, people are starting to worry on whether central banks are running out of policy bullets or what they do is going to be eventually effective. 6, economies now, after returning to growth in the third quarter, are starting to slow down again. The V might become a U. Additionally, the relation between US and China, the tension, the Cold War is becoming colder on trade, on tech, on investment, on monetary affairs. Additionally, there are significant risks coming from the US election. We may not have an election night. We might have an election week or month. The election might be contested, leading to a risk off. And as a combination of all these reasons now, markets from risk on are going into risk off because you have policy risk, political risks, geopolitical risk, and therefore economic risk. And they're going to stay with us through the end of the year. Now, let me think about what happened with this severe COVID-driven recession. First point, this was the deepest recession that the global economy had since World War II. It was even worse than the global financial crisis. Why? We had a policy-induced coma. We had to shut down economies in an almost synchronized way, first China, then Europe, then US, emerging markets, because we had to control the cases and try to flatten the curve. That's the bad news. The good news, however, was that this was also, even if very severe, the shortest recession we had, about 4 months, February, March, April, and May. And shortest because once we flattened the curve, we started reopening the economies, and there was a massive monetary, fiscal, and credit stimulus that boosted economic activity. So after the collapse in the first half of the year, the third quarter looks like a V, because starting from a very low base, even if you grow, say, 5% in a quarter, annualized, 5% times 4 is more than 20%. However, the question is not about the third quarter, but what's going to occur afterwards. Will we continue with a V-shaped recovery, or are we going to go to an anemic subpar U? What's even the risk of a W, a double dip recession? What's even the risk of a medium-term near depression? The data suggests, at least for the US, that even the recovery of the third quarter is starting to slow down. Spread of the COVID in the Sun Belt, South and West, and the Midwest, and a botched health response. Possible second wave in the fall. Risk of a fiscal cliff. US electoral uncertainty. Potential for a rise in business and corporate bankruptcies and a wave of evictions and foreclosures on tenants and homeowners. Still high unemployment rates. Uncertainty and risk aversion for households and businesses, and need for deleveraging of the private sector. I'll let Daniel and others speak about what's happening in Europe. There is also a slowdown now in emerging markets, given the spread of the contagion in many countries and more limited policy response. And of course, health issues are more complex in emerging markets that don't have developed health systems. These financial fragilities in emerging markets include dollar debts, shock to commodity prices, shock to tourism revenues, shocks to remittances, and of course, high unemployment and underemployment. Things are slightly better in China and in emerging Asia, given the links with China. But even in China, the policy stimulus has been more on the supply side and public investment, less to boost demand and consumption. And China is trying to grow itself out of the problem, not through domestic demand, but through a surge in exports, maybe dumping of it, that may not be sustainable if the rest of the world slows down. So while the number for the third quarter suggests a V, the risk is that the V by Q4 becomes a U, and the U could become into a W, a double dip, if we have a second wave in the fall and we don't have a vaccine in time. If you think about it, the number of cases is rising. We have reopened many countries too soon, too fast. Some people believe that we need another full lockdown to stop the contagion. Other people believe that using masks, face coverings, social distancing, and restricting indoor activity is going to be enough. But returning to work after summer vacation, returning to school, from primary schools to university, is leading to a larger number of cases all over the world. And in the fall and winter, we might have a second wave. And emerging markets have weaker health system and more density of population. But the political appetite for another full lockdown is close to non-existent. And there is a trade-off, of course, between the economic cost of restrictions and the health risk of reopening too soon, too fast. And unfortunately, even the prospects for vaccines are not ideal. The good news is there are 6 vaccines that are in phase 3 trials, but the idea of having vaccines by November, December, safe and effective so we can vaccinate most people in the first half of next year doesn't look likely. It's more likely that the safe vaccine is going to come out sometime next year, and therefore we're going to go through a difficult fall and winter without the vaccine. And that's going to be problematic for the recovery of sentiment, business, consumer investment, and of the economy. Now, the good news is that we have had massive policy stimulus, monetary, fiscal, credit to help illiquid but solvent institution. The Fed has even gone to flexible average inflation targeting. That means lower for longer. And of course, we had massive fiscal stimulus around the world. However, there are question marks about the buildup of private and public debt. How we're going to get out of these debts if growth and jobs are not recovering fast enough? How we're going to reduce the balance sheets of central banks? In the short run, of course, given the slack in goods market, labor markets, real estate and commodity, risk is lowflation, disinflation, even deflation. But over time, if we monetize large fiscal deficits in a world in which there are negative supply shock like deglobalization and more protectionism, eventually monetization of fiscal deficit may lead, not the zero next by 2022, to higher inflation or even stagflation. That's what happened in the 70s when we had oil shock and we monetized fiscal deficits. And therefore, that's a risk we're facing. In the US, there are 4 risks. Risk number 1, fiscal cliff, given that Democrats and Republicans don't agree on a 4 fiscal package that is needed for the economy. Secondly, there is foreign interference in the election by Russia, China, Iran, or Korea to try to weaken the US from within and create electoral chaos. Disinformation, misinformation, deep fakes, trolls, bots, feeding a variety of conspiracy. We have a risk of a contested election. If the polls narrow, either side, if the losers are going to say rigged, irregularities, fraud, and it's not going to be election night. It's going to be election week or weeks or months. You could have chaos going into the court, into the Supreme Court, into Congress, even unrest, if not violence in the streets. Half of the country is going to believe either way that the election was stolen from them, and therefore you could have a significant market correction. In 2000, when you had Gore versus Bush, ended up in Supreme Court, market fell 7%. This time around is going to be much more ugly than that. Final question on the US. If Biden wins, what's it going to be the impact on the economy and the market? Some market folks worry that it's going to raise taxes on corporates and on the rich, and that's going to hurt the market. But it's going to be having more fiscal stimulus, more pro-job and more pro-growth policies, more infrastructure spending, more green economy, more labor income for workers, less trade wars, and all of this could improve growth, and it could improve the economy, and it could actually improve the market. So that might be the positive if Biden wins, but that's a big if. What about the US-China relation? The Cold War between US and China is becoming colder, both for cyclical and structural reasons. There has been an escalation of this relationship. Hawkish speeches by US officials accusing the Chinese Communist Party of spreading the virus and being a threat to US economic and national security, closing of consulates, crackdown by China on Hong Kong, and US legislation restricting Hong Kong trade and punishing Hong Kong and Chinese residents, tension rising on Taiwan, on the South China Sea, the trade, tech, finance, and investment war between US and China is escalating, ban on Huawei and other Chinese tech firms, TikTok and WeChat ban, delisting maybe of Chinese firms that are in US equity market, new regulation restricting inward investment by Chinese in the United States, limits to their movements of labor, capital, data, technology, information, is driven not only by cyclical electoral factors. Trump is weak in the poll as to bash China, but also more structural one, as US and China are in a competition. The Thucydides trap, as you remember, the Greek historian wrote The Rise of Athens Threatening an Existing Power, Sparta, that led to conflict. There is a new Thucydides trap between US and China. Rising China facing US, leading therefore to a fight on who's going to be controlling the industries of the future. AI, robotic, automation, avionics, EV, automated cars, biotech, you name it. And even if Biden is elected, we'll have a managed strategic competition between US and China, if not an outright strategic competition and containment if Trump is elected. There is even a risk of accidents that may lead to a military confrontation. Hotspots are Taiwan and the South China Sea. That's a risk that we have to keep in mind. In the Middle East, the peace between Israel and some Arab states may be good news, but there is another type of risk that you have to worry about. Some people start to worry about an October surprise. Trump is weak in a poll. What if he wants to attack Iran for a wag the dog attack? What if Israel wants to attack Iran because if Biden is elected, he's going to go and do a new nuclear deal with Iran? What if Iran, that has been subject to a bunch of military attacks allegedly by US and Israel against military and civilian, decide to strike back in October to create chaos? So there could be chaos or October surprise that might be affecting the markets between now and before the end of the year. That's another risk that we have to keep in mind. So if we think about it overall, there is a whole bunch of risks that we have to face right now. Some of these risks may turn out better. Maybe we contain the contagion. Maybe we find a vaccine sooner. Fiscal stimulus. Maybe central bank do more. Maybe the economy recover. Maybe the election is not contested. Maybe US and China don't go and escalate. Maybe the Middle East stays calm, in which case the recovery of the economy, of the market can be better. But my fear is that this recovery, even in the best circumstances, is going to be a U-shaped recovery. Firms have to deleverage because they had too much debt and they have to survive. Deleverage means spend less, save more, do less capex. But your labor costs are my labor income, and my labor income is my consumption. So both households and firms deleverage by spending less, saving more, and doing less capital spending. And therefore, that implies a recovery that is more U-shaped. There is a V until recently in financial market, but there is a division between Wall Street and Main Street. Main Street is workers, small businesses, and households. Wall Street is big banks, big tech, big firms, and the interest of the two diverge. This is a K-shaped recovery. Those who have jobs and wealth are doing better. Those who have threat to jobs and income and don't have much wealth are going down. Therefore, inequality is rising, maybe a source of social and political instability. Therefore, even if the market until now were doing well, the real economy is going to suffer. Unfortunately, the recovery is going to be more like a U, and it's going to be up to sound policies and sound policymaker to make sure it doesn't get any worse than this. I will stop here.
Nouriel, thank you very much. We appreciate your view on US, China, and the global economy. I would like to move to Daniel Gros. Daniel.
Yes, and many thanks for having me in this illustrious panel. It's a pleasure in particular to speak after Nouriel, Roubini, who has outlined all this phase global economy. Nouriel has talked about financial markets. I will try to concentrate a bit more on the real economy and on Europe, where I'm sitting. And in particular, I think the first piece of analysis one has to do is what are the differences across Europe? Because the European economy is not one entity, but it consists of 27 member countries. And different member countries have had very different experiences. GDP has fallen everywhere, but only by 1/2 as much in Germany, for example, than in Italy or Spain. So the first question should be, why these differences in the fall of output in the first half of this year? And my own research suggests that the key element in the depth of the recession across countries was the restrictiveness of the measures which countries have been taking. There's an indicator elaborated by the University of Oxford, which basically puts together restrictions on school closing, pub closing, work from home, and so on. And this indicator actually explains most of the difference across European countries, meaning the differences in the restrictiveness of these measures were quite large as well. In Italy, we already had a totally lockdown. In Germany, much less. Of course, in Sweden, also much less. And this indicator already explains one important part of the differences. The second part is, of course, that there are certain sectors, as Stelios mentioned earlier, which are affected much more strongly, like tourism, hospitality, and so on. And the importance of tourism in the economy explains also an important part of the differences in the strength of the recession that we have seen this year. And I think the minister will be more qualified than I am to talk about the importance of tourism and hospitality for the Greek economy. What's interesting is perhaps also what we did not find. We did not find that the number of infections per se has an impact on the recession. So it seems that even if the newspapers talk a lot about a second wave, and people maybe should be getting more cautious and spend less when they hear about many more infections, this is not the case. So I would say that if we look now at this second wave, which many people fear, it's not so much the second wave in infection we should be worrying about, but a second wave of restrictions. As Nouriel said, there's great resistance now against a further total lockdown, but even incremental increases in the restrictiveness might slow down the recovery, which otherwise we have seen. So I think that is the first element to keep in mind. Strangely enough, we also did not find any impact so far of the governmental measures on the differences in the recession. Some countries have spent more than others, but you do not seem to find that in the recession and also the recovery so far. And that might be related to what Stelios mentioned earlier, which is that this recession and even more the recovery is very special. Some sectors of the economy are much more hit than others, especially after the first complete lockdown, now that certain parts of the economy are almost operating as normally as before. But some sectors remain weak, especially again tourism, travel, on which Greece depends so much. And that means that it is very difficult to combat this recession, because even if government give people more money to spend, they might not spend it. They might certainly not spend it on holiday trips if they can't do it, or if governments declare other countries as a red zone, and therefore if you go to that country and come back, you have to go 2 weeks in quarantine. That's a very high tax on movements. So this means that this recovery should actually, in my view, continue. In Germany, where I'm sitting right now, actually there's great optimism that recovery will be actually stronger than foreseen, partially on the back of stronger than foreseen exports to Asia and China, And Nouriel already said that China is actually recovering quite nicely. Of course, I don't want to neglect the importance of all the very large fiscal and monetary measures which were taken when the crisis seemed really to turn into catastrophe in March, April this year, when financial markets were extremely unstable. That was one lesson learned which was applied. Lesson learned from 2008 was you cannot leave financial markets alone. Central banks have to become the lender of last resort when people become irrational and try to sell everything. And that was a lesson well learned, and that contributed to the very quick stabilization of financial markets. In Europe, that is mainly debt markets, which have stabilized. In the US, of course, it is much more the equity market, which has, as Nouriel said, more than stabilized. But in Europe, the key thing was to get to impede risk spreads to go out of control. And that has been achieved by the very forceful intervention of the ECB. The big European Council decision of creating a recovery resilience fund, which actually was possible because of an agreement between France and Germany 2 weeks before, of course, created another, element plank to calm down financial markets and to make this recovery possible. And I must say that this agreement is really extraordinary because basically Germany gave up a red line which it had defended until basically a week or a day before they took this decision. And what I find even more important about this change in the German position is one aspect which is very often not given enough importance. And it is that this decision, basically taken by Angela Merkel, to concede to demands by France and others to have a common fund and to provide the hardest hit countries with grants, not just with loans. This decision is now taken as the new orthodoxy in Germany. There's almost no German politician of any importance who says this was a red line, we shouldn't have crossed it, this is a bad decision. It's very difficult to find anybody who is against it. And I think that's very important because it means that this was not just a one-off due to this, in a certain sense it was of course a one-off due to this recession and the COVID crisis, but it is not something which is done against the will of a large fraction of German society. And therefore, Germany now is basically fully on board with this decision. And for the German political elite now, the basic task is to actually implement it. Not to make it smaller, to criticize it, and so on, but now they want to make it a success because they feel ownership of it. I think that's very important because it speaks to the importance of Europe for the German political system to an extent which was not visible, I think, earlier. And that leaves me to perhaps to further consideration. One, as you mentioned, Stelios, which is to make a success out of this Resilience and Recovery Fund, RRF, it is called. And the second point is there another lesson from 2008 which we should take into account or which we should perhaps unlearn? And let me start perhaps with this second question. Many people take it for granted that the first lesson of 2008-9 was central banks have to become lender of last resort. You have to stabilize financial markets, otherwise the economy cannot recover. And I would say, check, that was done, implemented. The second lesson, which is more, contested and not accepted by some people in Germany, but held by many people, which was that you should not let up on fiscal stimulus until the output gap is closed. And I think this is a lesson which we might have to unlearn. As I mentioned earlier, when the economy recovers as it does now, most sectors can function. We will still have an output gap because there are sectors, tourism, personal services or services requiring personal contact, which will remain weak. And just giving people more money doesn't lead to more spending on these sectors. And actually, the few estimates which we have right now actually show that most of the consumers in Europe and also in the United States actually saved most of the transfers they received from governments. So perhaps ask ourselves, can we best use fiscal policy in a situation in where is an output gap, but a sectoral output gap? Not a lack of aggregate demand, but a lack of demand or lack of supply also in specific sectors. What can we do at that point? And here, my idea would be that governments, of course, have to help people who are in these sectors. They have to prevent mass redundancies. They have to provide some liquidity to enterprises. And most importantly, they have to provide people who might otherwise be fired with replacement income. In almost all European countries, we now have massive short-term working schemes whereby the firms get money to keep people on their payroll. And even if these people are not working, they have almost fully the same income as they would be if they were working. That is, of course, the ideal measure to take when you have a very short and sharp recession. And you know that most people, in the end, will come back to the same jobs because the structure of the economy doesn't really have to change. And that was the case in Germany, for example, 2008-9, already less in other countries. And here I think we have to think carefully because, as I mentioned earlier, some sectors have been very much affected by this, and some sectors might not come back as before. Consumers might change their habits permanently. The digitalization of the European economy, we were always hoping, might really make a big leap ahead. And if that is the case, then there will be many enterprises, many jobs, which will not and should not come back after the recession is over. And therefore, I think policymakers have one very difficult task. They have to provide workers with replacement income, but in a way that provides these workers also with to change jobs. That is empty to keep people on their payroll for 18, 24 months, just so that these job relations are not disturbed, when that hotel might not be viable anyway after 2 years. The same might be might be applied to local shops, many of which might also not come back as people buy much more online now. So my concrete proposal would be to say, if governments want to keep the incentives for change intact, should perhaps give people vouchers that should tell people, we understand your enterprise is not working right now as before. We have this short-term working time scheme, but you get the money anyway, even if you change job. And actually, we encourage you to change jobs, to work somewhere else in another sector, because that means that once this is over, we won't have a big structural adjustment program. So this is, for me, the biggest challenge facing Europe right now, how to avoid freezing the large sectors of the economy in place. And that applies at the national level and also for the Recovery and Resilience Fund. It should not be used to help countries to just keep their workers in place doing the same old jobs. It should be used to create new jobs in the digital area and the green area. And that means it really needs to be spent very differently from the way European funds have been spent in the past. And that is the challenge for ministers like the finance minister of Greece, who can now count, I think, on strong support from the European Union. How best to apply this funding which becomes available, not to just basically keep Greece afloat on the basis of the old economy, but to create a new economy. And with that, I think the floor should pass to you, Minister.
Daniel, thank you for the penetrating analysis of the status of the European economy and the Rescue and Resilience Fund. And now we will go to Minister of Finance, Christos Staikouras. Minister.
Thank you very much. First of all, I would like to congratulate the Harvard Business School Club of Greece for managing to organize this webinar discussion despite the difficult current circumstances, taking into account an advantage of the digital technology. Of course, it's a great pleasure for me to be here with such a distinguished panel, but also a distinguished web audience. Today's discussion takes place in a period of high uncertainty due mainly to the COVID-19 outbreak, an exogenous shock leading in the shrinking of European economies at a precedented rhythm. Unavoidably, the same happens for the Greek economy. Nevertheless, it has depicted remarkable resilience. More specifically, according to the provisional available data, in the first semester of 2020, the Greek economy shrank by 7.9%, while the euro area's average was minus 9%. The Portuguese economy shrank by 9.3%, the Italian by 11.7%, the French by 12.3%, and the Spanish by 13.1%. This is the result of the timely taken, cohesive, well-targeted measures of the government, which took advantage of the available and the existing fiscal and monetary flexibility. This was recognized in June in the statement of the Eurogroup, which, on quote, commended the Greek authorities for the quick and decisive policy response, both in containing the outbreak of the virus and in taking the necessary economic and fiscal support measures. But also, this was confirmed yesterday in the 7th Enhanced Surveillance Report, which mentioned that the Greek government has to date managed to contain the spread of the coronavirus outbreak and mobilized a large amount of measures to limit its social and economic costs. Indeed, we implement fiscal and non-fiscal liquidity measures of a total value of around 24 billion euros, around 13% of GDP, in order to protect human life and public health and support households and enterprises. These measures, among others, include a significant reduction or even zeroing of the corporate tax advance for enterprises, depending on their turnover decrease, one-off VAT reduction on specific sectors like transports, coffees, beverages, tourism package, etc., deferrals, special allowances for employees and self-employed, take into account seasonal workers, short-term employment schemes based on the SURE program, business financing in the form of a refundable advance payment or through state guarantees, extension of the regular unemployment benefits, and targeted measures for sectors more severely affected by the crisis, as Daniel mentioned before, such as tourism, air, and maritime transport. These measures also include the ones announced recently by the Prime Minister to protect employment, to enforce the productive activity, and to support the income of the most vulnerable, while always holding reserves for a future which remains uncertain. Among others, a reduction of social security contributions by 3 percentage points for the private sector employees for 2021, aiming to reduce unit labor cost, sustain and increase employment, and provide incentives for new hirings, and of course, the abolishment of solidarity tax for salaried private sector employees, self-employed, farmers, or rentiers for 2021. All these are financed by the prudent and neat management of the country's cash reserves. Cash reserves which have been significantly strengthened during the last year through 6 successful debt issuances of a total amount of 14 billion euros. The highlight was the most recent 10-year GGB issuance at the lowest borrowing cost ever in the country. At the moment, cash reserves stand at 37.7 billion euros, a bit higher compared with the beginning of the crisis, and they are expected to be further augmented by the use of the existing European financial instruments. At the same time, amid the crisis, as Minister of Finance, we proceeded with the implementation of important structural reforms. Indicatively, during the last 6 months, a new program to support borrowers affected by the coronavirus crisis has been launched and is being successfully running. Public consultancy on a holistic, socially sensible, and nationally growth productive framework to tackle the high burden of private debt has been completed. The institutional framework for corporate governance and the capital market has been upgraded and modernized. The framework for microfinance has been enacted. The asset development plan has been boosted in cases where it was possible, as for example in the Hellenikon project and the 3 peripheral ports. Plans to enhance the sustainability of specific companies have put into action. Consequently, we have made good use of time in order to speed up reforms, aiming at enhancing economic effectiveness and social justice. Furthermore, as it was mentioned yesterday in the 7th Enhanced Surveillance Report, good progress has been made also in other fields, like investment licensing reform, with the abolition of the obsolete nuisance classification system and the reclassification of economic activities based on environmental criteria harmonized with EU legislation, which expected to materially ease the burden on the industrial sector. Energy policy, with the continued decommissioning of lignite plants and progress on the target model. On public administration, and finally, the government has also made good progress on other reforms, which are expected to have a significant impact on the business environment and investment sentiment. This includes an ambitious reform of vocational education and advances on digital governance. Nevertheless, I will repeat publicly that we do not turn a blind eye, nor are we celebrating. We are aware, as Mr. Savos mentioned before, of the national, social, and economic challenges ahead of us. We are in a geopolitically sensitive and interesting area of the planet. We're working prudently and methodically to overcome difficulties, to share the country's defense, to successfully tackle the health crisis, population movement, geopolitical turbulences, the return of our economies to the pre-crisis level the soonest possible, to take advantage of the fiscal flexibility with prudence, which will continue to exist at least in 2021, to have a significant rebound in 2021, and of course, to make the best use of the available European funds through the implementation of our own national growth strategy. A strategy which will be the springboard to reorient the Greek economy to a new production and growth model, and thus to achieve high, sustainable, clever, and socially fair growth. This growth can be achieved based on the important firepower that we have secured, approximately 72 billion euros from Next Generation EU and the European Union's multi-annual financial framework. At this point, I have to stress that Europe's response to this exogenous and symmetric crisis has been prompt and dynamic in order to avoid fragmentation, in contrast with what occurred a decade ago. Important decisions were taken, and both fiscal and liquidity boosting measures were activated. Just to pick up some of them, fiscal rules, targets, and requirements were lifted. The framework for state aid and public procurement became more flexible. The ECB has introduced the PEPP and has adopted a package of temporary collateral easing measures. Europe activated a safety net for states, employees, and businesses through the ESM pandemic crisis support, through the SURE program to subsidize employment, and through the Pan-European EIB Guarantee Fund to strengthen business liquidity. And most of all, the Recovery and Resilience Facility was added to our armory, the new orthodoxy in most European Union countries, as was mentioned before. Greece is expected to receive through RRF about 19 billion euros in grants, while it can receive an additional 12.7 billion euros in loans. In addition, it will raise 40 billion euros from the multi-annual financial framework for the period 2021-2027. This poses a unique opportunity for Greece to boost economic activity over the period through both investments and reforms that will have a prolonged and sustainable impact on the country's long-term economic outlook. The big challenge ahead is the swift restart of the Greek economy and its reorientation to a new growth model. Our priority is to achieve high and sustainable growth and to improve its composition. Greece faced for many years a significant investment gap. We have to close it. In this direction, we are setting forth two interrelated objectives. The first is how we will close the negative output gap, safeguarding at the same time responsible public finances. And the second, how we will improve the economy's supply side, in other words, its productive capacity, in order to achieve sustainable growth, sustainable and inclusive growth rates with a high level of social cohesion. To achieve these objectives, we have ambitious plans for the period ahead, and we are already working decisively on our national growth strategy. We plan to make the best use of these funds in order to implement policies based on the objectives set on that, which include, among others, the implementation of a fiscal policy with a gradual reduction of tax rates and social security contributions, the continuation of the privatization program, as well as the exploitation of public property, the digital transformation of the public sector, the simplification of the license procedures, and the reduction of the bureaucratic burden, the implementation of structural reforms concerning the regulatory framework for businesses, the faster delivery of justice, the agricultural sector, the promotion of public investment, and the support of private investment initiatives of high added value, emphasizing on the development of infrastructure, on digital technologies, on the industry stimulation, on the stimulation of endogenous sources of development, such as education, research and innovation, and the green economy. Among other areas, as was mentioned before, we have to provide incentives for reskilling, for long-term learning, and also to plan major investments in areas including efficient use of energy, networks upgrading, renewables, recycling, waste management, protection and enhancement of natural environment, and biodiversity. Such investment will underpin sustainable growth and job creation in ways that protect environment and social cohesion. To conclude, taking advantage of all the above, we will have the opportunity not only to recover, but to enter a strong and sustainable upward trajectory, an opportunity that we are decided to seize in order to restructure the economy, to enhance its productivity, and to improve its competitiveness. Thank you once again.
Minister, thank you very much. Several members of the audience have sent specific questions which I would like to address to the panelists. The first question goes to Minister Staikouras and says that the next generation EU recovery instrument offers, and specifically the resilience and recovery facility, offers powerful funding and accelerate the green and digital transitions. But the timetable to absorb and utilize this funding is less than 5 years from start to finish. Could you tell us your thinking as to the specific mechanism that you as a minister and the government you will utilize to examine, select and allocate the funding to the specific projects so that the investments are carried out and executed effectively within the allocated time frame?
Okay, thank you very much. First of all, to have a timetable in front of us, the recovery funds are expected to start receiving in Greece during the first semester of 2021. 70% of the grants provided by the RRF shall be committed in the years 2021 and 2022. The remaining 30% shall be fully committed by the end of 2023. The total envelope should be disbursed by 2026. Based on that timetable and on the pillars, in order to make proposals that were circulated, I have a piece of paper in front of me, on the 17th of September, just a few days ago, the flagship projects that have been provided by the European Commission, the Prime Minister has set a steering committee which takes all the proposals coming up from different ministries and ministers, and we will provide it by the mid of October to the European Commission. I will repeat that this holistic approach will aim to boost productivity, to better connect production with technology and innovation, to support, as was mentioned before, labor market dynamics, to strengthen wage labor, to invest in education and innovation, to raise the size of enterprises, to promote cutting-edge technology, innovation, and digitalization, to achieve ambitious environmental goals, and to support weak households. Thank you.
The next question I will address to Nouriel Roubini. It says, is there a difference in the foreign policy if Biden gets elected? And would this change dramatically the US trade policy toward China? Because it is generally accepted that Biden will work with allies and lead to a much higher stakes trade war. What's your opinion, Nouriel?
I do expect that the foreign policies of a Biden administration will be quite different from those of the Trump administration. You know, in summary, Trump was a unilateralist, if not isolationist, was criticizing, if not insulting, allies in Europe and Asia, was coddling dictators and authoritarian regimes, was getting out of international organizations and agreements like TPP, the Paris Accord, the WHO, built a colder war with China, has challenged Iran aggressively, has been protectionist, and his slogans were MAGA, Make America Great Again, and America First. Biden is likely to be more internationalist, cooperate with allies in Europe and Asia, still be tough with China, but try to have a strategic dialogue with China to avoid an escalation, and maybe co-involve allies in Europe and Asia in that dialogue, because even European and Asians have concerns about trade and investment practices of China. He's likely to be slightly less protectionist, go for greater trade agreements, support the EU and NATO rather than try to undermine the EU and NATO. It might try to re-engage Iran into a new joint comprehensive plan of action. It might create more complex relation, of course, with Israel and the Gulf states, but Biden Democrats have always been supportive of Israel, and probably this new process of greater between Israel and a number of Arab states is going to be enhanced. Biden is going to have more constructive migration policies that are going to help relation with Central America and Latin America. And it's going to be more collaborative with international organization and agreement, whether it is the reform of the WTO, WHO, UN, IMF, World Bank, and other international organizations. And therefore, I think that the foreign policies of the Biden administrations are going to be more constructive for global markets, especially emerging markets in Asia, like equities and FX, that under Trump would lead to a greater escalation of the tension with China. However, the relation between US and China are going to be difficult, regardless of whether Trump is in power or Biden. Under Trump, you have strategic competition and attempt to contain China. Under Biden, we may have only managed the strategic competition or co-opetition. That means competing on certain things and cooperating on other things. Maybe, hopefully, if US and Europe have better relationship, they can engage themselves and China to try to build a new international economic system where in addition to competition with China and pushing back on some of the more aggressive economic, financial, but also geopolitical ambition of China, you have a more constructive attitude. So Europe can play a good role and an important role to make sure that a system of international rules, regulation on trade, on investment, on technology, maintain a relatively more open global economic order.
Thank you very much. Nouriel, thank you very much. The next question goes to Daniel Gros. Daniel, you argued quite effectively that this is not a usual recession. Simply funding the demand will not work. You argue that what is really needed is to forge structural reforms, including ambitious climate targets, which are required across the European Union to boost the growth potential of the member states. Could you please elaborate some more on which structural reforms you envision? And also, can you elaborate on the case of Greece, if you will?
Okay, there are more knowledgeable people about Greece on this call, but let me just say this on Greece, that I had some intensive conversations with German policymakers these days. And as I said earlier, they fully support the Next Generation EU instrument. They want to make the Recovery and Resilience Fund a success. But in the end, then they always come back to their concern, which is Italy. It is not Greece anymore. Greece is basically now taken as a sort of success case. And I think the fact that Greece is no longer in the headlines was one of the elements also which made this entire agreement on this Recovery and Resilience Fund possible in Germany. If we still had been talking about Greece as a basket case, not respecting its engagements, not having a functioning economy, I think it would have been very difficult to sell it in Germany. So I think this is the ultimate compliment perhaps one can make to the Greek government of today. So in that sense, I don't want to say more about your country, which seems to be in quite competent hands. But it is really a problem, a headache now for policymakers, including in Germany. They say, okay, now I have a license to spend, but where does the spending make sense? Of course, it's easy to say spend more on green. But in the end, what counts is what do we want to achieve by 2030? We have a European trading system which sets a target, which will now be changed, minus 55% reduction compared to 1990 by the year 2030. And we have also a system to achieve that, a carbon price, at least for industry and the power sector. So I would say it doesn't make sense to spend the Recovery and Resilience Fund on the power sector. Because if you do that, the only thing you will do is you will basically make it easier for the private sector to achieve the same target. You will reduce the carbon price. And I think that is not what governments should do. Governments should look at the other sectors where we do not have a carbon price, sectors where it's more difficult for the private sector to actually come together and make the savings happening. For example, in terms of isolation of buildings. In Northern Europe, it's against the cold. In Greece, it might be more against the heat. The building sector, I think, will be one of the most difficult sectors to decarbonize. And we cannot start only in the year, 2029, because that's too late. The building stock is only being renovated very, very slowly in Europe. The rate of depreciation usually is said to be 1/50th every year. So these are sectors where the government should concentrate, not the ones which are easy, because technological progress is making wind power and solar power cheaper every day. That we can leave to the private sector. The government should really look at how can you make sure that, for example, in the building sector, which I mentioned, not only by throwing money, but again, here's a structural reform, how do you can recreate laws and regulations which make it easier for apartment buildings to form a coalition so that you can actually build some solar panels on the top, serving everybody, and not having to do it everybody by himself at much higher costs. These are examples, I think, of the structural reforms that you need. Apart, of course, from the labor market, and the minister already mentioned earlier that it's important to make the labor market more flexible. I would say, if not now, when? Because now is a time when you can actually tell people, look, we are making the market more flexible, but at the same time, we can give you more help. Help to find a new job, maybe help to find also new skills. And these are the kind of structural reforms that the minister should be thinking about. They should not be looking at the output gap and saying, okay, as long as output is X% below the previous level, we should spend more. They should think, what are the sectors which are still in need of help? And in some cases, will this help be temporary or permanent? And here I think one additional element comes in, which is the uncertainty. We just don't know whether tourism will come back in 2 years because we have a perfect vaccine, or as some people say, we will never get a perfect vaccine. And therefore, to deal with this uncertainty, I think one practical thing finance ministers can do is to say, we don't give companies just guaranteed loans, because if these loans go bad, the government pays. If the loans go well, okay, the enterprise continues, but there's no upside for the government. So I would recommend that the government think about using hybrid capital instruments when they're supporting enterprises, even small and medium-sized ones, so that they don't take over the company, but they get a share in the upside. Some silent partnerships, as they call in Germany, or something else, which makes sure that the government, if things go well, then also participates with higher dividends and payouts. And that's another, if you want, structural reform, which governments should be thinking about.
Thank you. The next question will go to Minister Staikouras. And there is an interesting question that what if the countries are not able to achieve their inflation goals, the economic growth goals? Do you perceive that we might need new stimulus packages from the ECB, which is also a main topic in the US debate, if we should get more stimulus? I mean, to confront potential uneasy deflationary phenomenon. And an additional element, this question, I'm trying to make it a little bit heavier for you, Minister. If in Greece, the measures we take, because Greece was hit much harder given the sectorial aspects, are not enough, do you envision looking into the future and consequently to proceed with more radical institutional and structural steps and changes to shield our economic and socio-political system? I combined two different questions together.
Many more questions and comments. First of all, I totally agree, and I share the concerns that Daniel mentioned before regarding that as a Minister of Finance, we have to focus not only on the output gap, I will repeat the output gap, but also on the economy supply side, take into account what are the prospects ahead. But for a country like Greece, with a significant investment gap, we have to tackle and we have to set forward two interrelated objectives. This is why we base our strategy on both of them. Now, on your second question, everything depends on the development of the pandemic. So we have to have the resources, to have the cash reserves in order to face the problems that may arise, taking into account how the development of the pandemic will go. However, behind your question is a very important issue: the pace of the adjustment. The pace of the adjustment at the European level. And this is something that we have agreed at the Eurogroup and the Ecofin level to discuss in 2021 for 2022 onward, also take into account, I will repeat it, the development of the pandemic. We should try and avoid an abrupt change from a highly expansionary to a strongly contractionary fiscal stance. A soft landing is needed so the transition back to a fiscally sustainable budgetary position is smooth, while the support to the economy should continue in some form and to some extent, taking into account that we will need at least 2 years to achieve the 2019 growth levels, according to the preliminary estimations coming up by the European Commission and the ECB. So I think this is extremely important, and this is why we have agreed at the European level with prudence to have fiscal flexibility even in 2021 for targeted and one-off measures. Thank you.
Thank you very much. I would like now to ask Daniel if, following the end, hopefully, of this pandemic crisis, we are going to reinstitute the measures, the tight measures of the stability package, and in addition to that, for efficiency purposes, what is the German position on the ECB proposal to render the recovery fund permanent?
Let me take the second question first. As I said, this recovery fund on paper is a one-off, but it can only remain a one-off if the Ministers of Finance agree on additional taxes to give to the European level to pay back these funds. And my prediction is that that will not happen. So de facto, the RFF will become permanent, and we'll have an additional, let's say, give or take, around 800 billion of European bonds around for, let's say, 2 generations at least. I think that's not a big deal. The European economy can take it, and Germany will always say, we don't like it. And then people will say, yes, you don't like it, but do you agree on increasing taxes? No, they say we like that even less. Okay, so I think that is how the way reality will evolve. On the fiscal rules, here I think we have 2 elements. The first one is that it is quite clear that the numerical rules that we have had until now cannot really be reinstated. 3% and 60% were calibrated on numbers from the 1990s, and already over the last years they made little sense. They were actually not really imposed. So the of these regulations cannot be reinstituted. A totally different question is their spirit. Their spirit was, it is better to keep debt low and actually to reduce debt during good times. That had always been also the German position. I think the black zero was widely misunderstood. This was, in a sense, insurance. The German political establishment thought, now times are good, When times are good, one should reduce debt. And I would submit to you that actually this crisis has shown that it is useful to have a low debt level. I mean, France, Italy, Spain, not to speak of Greece, have much more difficulties helping their economies because they went into this extraordinary crisis with a very high debt level. And the lesson from this crisis is now we have had one in a generation crisis in the space of 10 years. Who knows what the future will bring? Nouriel talked about all the risks facing the global economy. China, US confrontation, India, China, perhaps, who knows? And therefore, I would say that the spirit of the old Stability Pact, namely, when times have normalized, you should try to reduce debt. That spirit will survive. The numbers might be different, but I think also that it does make sense not to return immediately to austerity, but to have a path towards a fiscal policy which keeps debt at a manageable level. And I think the level we have reached in Europe right now is already borderline to what we can support in Europe. So, to make a long story short, the old rules will not be reinstated formally, but the pressure to keep deficits and debts low will remain.
Nouriel, what is your view on euro dollar? And for efficiency of time, there was another interesting question. We increased public spending by increasing public debt, not increasing the taxes. Borrow rather than tax. Do you think this continue even post-pandemic?
Well, on the value of the euro relative to the US dollar, during the peak of the crisis, of course, for a short period in March, the dollar was appreciating because we were in risk off, and there was massive amounts of dollar illiquidity. But then in the last few months, the dollar has started to depreciate relative to major currencies, including relative to the euro. Dollar is weak because the Fed is very aggressive. I would say even more aggressive than ECB, BOJ, BOE, and so on. Until recently, dollar was weak because we're in risk on. When risk is on, people tend to move into other markets, and therefore the dollar weakens. Dollar is weakened because we have massive monetized fiscal deficits, and the deficits in US are even larger than other advanced economies. And the Fed is committed first to essentially unlimited QE, and with its new policy of flexible average inflation targeting, of staying even lower for longer. There is also concern that eventually this US policy is going to lead to a fiat currency debasement. The illiquidity in the dollar that was in February, March went away when the Fed created swap lines, repo lines, and then IMF and World Bank started to lend dollars. So that put downward pressure. And the US has a preference for a weak dollar because of the large US current account deficits. They don't say so, but they're in favor of protectionism and weak dollar. And if the US were to weaken growth because of a surge in COVID, that can also further weaken the dollar. And the US also has low savings rates and larger twin fiscal and current account deficits. In Europe, you have higher savings rates. You have budget deficits, but Europe runs a large current account surplus. Until interest rates were positive in the US, in spite of the twin deficits, the dollar could stay strong. But with those twin deficits and now near zero rates, then the support of the dollar is kind of fizzling out. Of course, over the next few months, the trend might be towards a weakening of the dollar, but the dollar can strengthen like it happened the last couple of days if you have risk-off episodes. if for some reason the Fed were to become less accommodative, if the ECB were to take even more aggressive easing action, if growth in Europe were to weaken strongly, that's going to be a concern. And of course, the ECB already started with some kind of a verbal intervention, what people refer to as open mouth operation, suggesting that if the euro keeps on appreciating, that may become a concern given the impact on European competitiveness. Of course, if the euro strengthens because the Eurozone economy strengthens, that's okay. If the euro strengthens because the dollar is weakening because of US problem, that is less okay. So there are many factors. One question finally is, some people worry that dollar is going to go into free fall and lose its role as a major global reserve currency. I think that is a less likely risk in the short run for many reasons. The first one is you cannot replace something with nothing. And for now, there is no alternative to the US dollar. Yes, the euro could become an important global reserve currency, but Europeans should be careful if they really wish that or not, by further internationalizing the euro with an even bigger RRF, because that may lead actually to a strengthening of the euro that may not be appealing for the European. Other currencies now going to become major global reserve currency, like the pound or the yen or the Swiss franc. We're not going to go back to the gold standard. And cryptocurrencies are not even currencies. They're not means of payment. They're not store of value. They're not unit of account. RMB, maybe eventually the Chinese currency could become a more important global reserve currency, but they have to liberalize exchange rates, capital control, deepen their own capital markets. It's not a democracy. It's not a market economy. So many are skeptical about that. But there is one risk for the dollar. The US is using the dollar as an instrument of foreign policies, weaponizing the dollar, imposing sanctions against its own strategic rivals, and then saying to the allies, if you don't follow my sanctions, I'm going to impose secondary sanctions. And that might lead eventually people to try to find alternative to the US dollar. Chinese, Russians, and other rivals of the US are saying, I worry about my dollar assets being seized or frozen, if not defaulted on. That's why they're moving away from dollar assets, say, into gold or other ones. So if the US were to use aggressively the US dollar as a tool of foreign national security policy and weaponize, that could be a trigger for a weakening of the dollar as a major global reserve currency.
Thank you very much, Nouriel. I would like to thank our three distinguished speakers: Minister of Finance Christos Staikouras, Dr. Daniel Gros, Professor Roubini, who accepted our invitation, and I hope that we all had an informative and constructive webinar. But we should never waste a crisis. The challenge is how we can seize the opportunities, the positive trends and conditions which could improve our society and economy, and lock the good ones for the long term. Working together, we can transform this period of deep adversity into an improved, shared well-being for us and the future generations. Thank you all for joining us this evening.